This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Hello, listeners, and welcome to the IUX podcast, a part of Trade Alive, brought to you by IUX Education and IUX Trading Platform. We help you explore the lives, lessons, and legacies of the world's greatest traders. I want you to picture this scenario. It is 8:29 a.m. on the first Friday of the month. You are sitting at your desk, your coffee is getting cold, your eyes are locked on the screen. In exactly 60 seconds, the United States is going to release the Non-Farm Payrolls Report, the NFP. You've done your research. You know the economy is booming. You're absolutely convinced the job numbers are going to be fantastic. So you load up your account, you maximize your leverage, and you hit buy on the US dollar. You are ready to make your entire month's profit in 3 seconds. The clock strikes 8:30. The news flashes across the screen. The job numbers are incredible. They completely crushed expectations. The US dollar isn't going up. It is collapsing. It drops 50 pips, then 80 pips, then 100 pips. Your screen flashes red. A warning pops up from your broker. Before you can even move your mouse to close the trade, your account balance hits zero. You have just been liquidated. You sit there in stunned silence. The data was good. The economy is strong. Why on earth did the market violently crash? Welcome to the brutal, unforgiving reality of trading high-impact economic news. Economic releases, like the NFP, the Consumer Price Index, CPI, and central bank interest rate decisions, are the ultimate double-edged swords of the financial markets. On one hand, they inject massive, instant volatility into the charts, presenting incredible short-term opportunities. On the other hand, they are the number one primary catalyst for sudden, violent position liquidations. Liquidation isn't just a loss. It is the forced closure of your trades by your broker because your margin has been rapidly, violently depleted by adverse price movements. It means you are out of the game. Today, we are going to dissect exactly why this happens. As highlighted by Vantage Market's educational insights on news trading strategies, successfully navigating these explosive windows requires a fundamental, complete shift in your perspective. The objective of analyzing economic data is not to guess the exact number. Let me repeat that. Your job is not to guess the data. Your job is to understand pre-existing market expectations and overall institutional sentiment. In this episode, we are going to break down the actual mechanics of the order book during a news release. We are going to build a concrete trading strategy for high-impact economic news that keeps you safe. We are going to teach you how to survive the initial storm, avoid the liquidation traps, and prepare for the true structural shifts in price action. To trade the news safely, you must first understand what is happening behind the scenes. You need to understand market mechanics. Amateurs look at a chart and see moving lines. Professionals look at a chart and see liquidity. Let's go back to the moments right before a major CPI release. Often, in the hours leading up to the news, you will notice the market enters a tight, quiet consolidation phase. The price barely moves. The market is essentially holding its breath. Then, seconds before the announcement, the big players step away. Market makers, massive institutional liquidity providers, and high-frequency algorithms do not like uncertainty. They are not going to leave billions of dollars of pending orders sitting in the order book right before an unpredictable economic bomb goes off. To protect their capital, they pull their pending orders. This sudden, massive withdrawal of liquidity creates what we call a liquidity vacuum. Because there are suddenly very few buyers and sellers actively quoting prices, the spread, The difference between the bid and the ask price widens dramatically. A normal 1 pip spread can instantly explode to 15, 20, or even 30 pips. Consequently, if you place a market order during this vacuum, you will experience severe slippage. You click buy at $100, but because there are no sellers at $100, the broker fills your order at the next available price, which might be $105. You are instantly down $5 before the trade even begins. Stop-loss orders can also be triggered at highly unfavorable prices, accelerating your capital drawdown. This is the chaotic environment you are stepping into. So how do we survive it? A viable trading strategy for high-impact economic news revolves around preparation, risk mitigation, and structural market analysis, rather than directional guessing. Let's break this down into actionable pillars. 1. Preparation via the economic calendar. Successful traders do not get caught off guard. They don't wake up and wonder why the market is moving fast. They monitor economic calendars daily. When you look at the calendar, you will see 3 numbers: the previous data, the forecast or consensus, and the actual data.
The financial markets operate on the classic principle of buy the rumor, sell the news. The market has already priced in the forecast. If the forecast predicts the CPI will drop from 4% to 3%, and the actual number comes in at 3%, the market might actually sell off, even though inflation dropped. Why? Because it was exactly what they expected. The big players bought the rumor weeks ago, and now they are taking profit on the news. The actual market reaction is usually driven only by how far the release data deviates from the consensus, not just the raw number itself. 2. Avoiding the breakout traps, the straddle myth. Let me expose a very popular, very dangerous strategy taught to beginners. It's called the straddle. The idea is simple. You don't know if the news is good or bad, so 1 minute before the release, you place a buy stop order above the current price and a sell stop order below the current price. You think, whichever way it explodes, I'll catch it. This is financial suicide. Remember the liquidity vacuum we just talked about? When the news hits, the spread widens aggressively. The ask price shoots up and triggers your buy stop. A millisecond later, the bid price shoots down and triggers your sell stop. You are now in 2 open trades, and because the spread is massive, both are deeply in the red. Then comes the whipsaw effect. The price shoots aggressively in one direction to clear out stop losses, then reverses hard into the actual trend. You get stopped out on both sides in a matter of seconds. Your account is liquidated. Never straddle the news. 3. Drastic leverage reduction. Because of this amplified distance that price can travel in seconds, your standard position sizing becomes a massive liability. If you normally risk 1% of your account using a standard lot, that same lot size during a news event could result in a 5% or 10% loss due to slippage and spread widening. The strategy is simple. Drastically reduce your leverage. Decrease your lot sizes by half or even a quarter. By trading smaller, you ensure that even if the wildest, most aggressive whipsaw occurs and your stop loss is triggered via slippage, the absolute financial impact remains well within your acceptable risk parameters. You survive the storm. 4. Waiting for the dust to settle. The post-release trend. This is the ultimate secret of the professionals. They do not trade the announcement, they trade the reaction to the announcement. Instead of entering a position precisely at 8:30 a.m. when the numbers drop, professionals sit on their hands. They watch the initial spike. They know that the initial spike is often a knee-jerk reaction driven by algorithms and a severe lack of liquidity. It is a trap. They wait 15 to 30 minutes. They wait for the spread to normalize. They wait for the institutional liquidity to return to the order book. Only then do they look at the chart. They ask, Where did the dust settle? Did we break a major resistance level? Did we form a new structural trend? Traders then look for a pullback or confirmation on a higher time frame, like the 15-minute or 1-hour chart. They trade in the direction of the true, newly established institutional trend, completely bypassing the chaotic, spread-widened bloodbath of the first 60 seconds. Let's bring it all together. Successfully navigating the financial markets during high-impact economic releases requires a fundamental, total shift in your mindset. You have to let go of the ego-driven desire to predict the exact data. You have to stop trying to be the hero who catches the absolute bottom or the absolute top of a news spike. Instead, you must focus on managing the subsequent market reaction. You must understand the underlying sentiment, constantly acknowledging that classic buy the rumor, sell the news dynamic. As we have explored today, the core reason retail traders face sudden liquidation during these chaotic events is a toxic combination of over-leveraging and a severe misunderstanding of market mechanics. When liquidity providers pull their orders, that resulting liquidity vacuum and the dramatically widened spreads inevitably trigger severe slippage, brutal breakout traps, and aggressive whipsaws that hunt down stop losses. By implementing a systematic trading strategy for high-impact economic news, you take back control. You emphasize meticulous preparation via the economic calendar. You engage in scenario planning, mapping out your support and resistance zones beforehand so you know exactly where price might react if the data beats, meets, or misses expectations. You drastically reduce your position sizing to protect your downside. And most importantly, you develop the ironclad patience to wait 15 to 30 minutes for the initial dust to settle. By doing this, you completely remove emotional decision-making from the heat of the moment. This disciplined, post-release execution approach allows you to observe macroeconomic events objectively. It allows you to capitalize on true, confirmed institutional trends rather than algorithmic noise. And, most importantly of all, it strictly adheres to the ultimate golden rule of trading: capital preservation. You cannot compound your wealth if your account is liquidated. Before we wrap up this episode of Trader's Lab, I want to leave you with a question, and I'd love for you to answer this in the comments below. Think back to your very first time trading a major news event like the NFP or CPI. Did you get caught in a whipsaw, or did you wait for the dust to settle? What was the biggest lesson that specific day taught you? Share your stories below. Let's learn from each other's battle scars. If this episode gave you valuable insight into how the market truly operates behind the scenes, please click like, subscribe, follow, and share it with another trader who might need this crucial reminder to protect their capital. Thank you so much for tuning in. Keep your leverage low, respect the volatility, and I'll see you in the next episode. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.